A piece headline can cool a screen, but it cannot refill a missing vault. Right now, silver is flashing a warning most people still do not see. More than 227 million ounces have been pushed through delivery pressure, while Iran keeps brushing aside peace signals. If that sounds like two different stories, that is exactly why this moment is so dangerous. If you like hearing the deeper truth before the crowd catches up, subscribe now and stand with the people who look past the headline and into the machinery underneath. Because this is not only about silver, it is about stress, trust, and what breaks first when the world pretends everything is under control. Iran's message has not sounded like a side preparing for easy peace. Its leaders have pushed back against talks that come with threats, and that matters because the Strait of Hormuz is not some faraway line on a map. It is one of the world's most sensitive energy choke points, and when that area feels unstable, the price of oil, transport, insurance, and risk can all change fast. Markets hear that kind of tension even when television tries to smooth it out, and silver, for a very specific reason, tends to hear it louder than most assets. Silver lives in two worlds at the same time. It is a precious metal, which means people run to it when fear rises, but it is also an industrial metal, which means factories, electronics, solar equipment, and advanced systems keep pulling on it too. So when global stress goes up, silver can get hit from both sides at once. Investors start paying more attention to safety, while industry still needs real metal in the background. That is why this story is not just about price on a chart, but about pressure inside the physical market itself. Now here is where the warning gets serious. A lot of people look at silver and only ask one question: is the price up or down today? But that is like staring at the speedometer while ignoring the smoke coming from under the hood. Recent reports around the futures market show that a huge amount of silver has already moved through delivery activity over a short stretch of time. And when you place that beside a much smaller pile of silver that is ready for immediate delivery, the message stops sounding normal. This is where smart viewers separate noise from signal. So if you value that kind of thinking, are you already subscribed to the channel that refuses to stop at the surface? When people hear 227 million ounces gone, they often picture silver vanishing into thin air. That is not the point. The point is that a very large amount of metal has been called on, moved, or tied up through delivery pressure, while the pool of silver ready to meet fresh demand has looked much tighter. That does not mean the market fails tomorrow morning. It means the room for error gets smaller, and when room for error gets smaller, small shocks can suddenly feel huge. To understand why, you need one simple distinction. Some silver sitting in approved warehouses is there, but not ready to be handed over right away against a futures contract. Think of that as stock sitting in the building but not yet on the front shelf. Then there is the silver already set aside and available for immediate delivery. That is the shelf people can actually grab from when they show up with a claim ticket in hand. If the front shelf is getting thinner while more people are watching the same shelf, the mood changes. Not always in one dramatic explosion. Sometimes it changes slowly, like a crowd forming outside a store before the doors open. The shelves may not be empty yet, but the behavior tells you demand is becoming more serious than the public story suggests. And that is why the silver market has started to feel less like a calm investment story and more like a pressure test. So ask yourself this: if the ready pile is already under strain before the next shock lands, what do you think happens if fear rises again, and more buyers want real metal instead of paper promises? Now bring Iran back into the picture. When leaders reject talks that seem to come with pressure, the market does not hear diplomacy. It hears delay, mistrust, and the chance that the next step could be harsher than the last one. Even without a fresh blast on the battlefield, a cold answer to a peace push can keep tension alive. And in markets, uncertainty often does as much damage as open conflict, because nobody can price the future with confidence. That matters for silver because oil and silver are not strangers. If tension around Hormuz keeps energy markets nervous, the cost of mining, refining, shipping, and ensuring metal can rise. At the same time, higher oil can feed inflation fears, and inflation fears can drive more people toward hard assets. So silver does not just react to war headlines like a news item. It reacts through cost, fear, supply chains, and investor psychology all at once. A lot of people assume that if a peace headline finally appears, the whole silver story will just cool down. But even if diplomats surprise the market, a handshake does not instantly rebuild missing inventories. It does not erase years of tight supply. It does not cancel industrial demand from the technologies that still need silver in the real world. And it does not force holders of physical metal to suddenly release it just because the tone on television softened for a day. That is one of the biggest mistakes people make in markets. They think the headline creates the whole move. Sometimes the headline only reveals stress that was already there. It is like rain exposing a crack in a roof that had been growing for months. The rain gets blamed, but the weakness was already built into the structure. If this is making you question what the market really runs on, why not subscribe now and stay close to a channel that watches the structure before the stampede begins? And the structure in silver has not been calm for a while. Major industry research has pointed to another year of deficit, meaning the world is expected to use more silver than it produces again. That would make it the sixth straight year of that problem. Over the past several years, hundreds of millions of ounces have already been drawn from above-ground stocks to help cover the gap. That is not a tiny mismatch. That is a long grind that slowly eats away at the cushion people assume will always be there. Why is the cushion shrinking? Because silver is not just jewelry and coins. It goes into electronics, power systems, solar equipment, medical tools, and many of the machines that modern life now depends on. Some of that silver gets recycled, but not all of it comes back easily, and not all of it comes back cheaply. So every year of deficit is not just a market note. It is one more year where the future depends on drawing from stock that already exists above ground. Then there is the global buying behavior, which makes this even more interesting. China has shown unusually strong appetite for silver imports, with reports describing record monthly inflows earlier this year. Turkey has also posted striking import numbers, far above what many people would expect from normal monthly demand. When countries and major buyers start pulling in that kind of metal, you should not treat it like random shopping. You should ask what they see coming that smaller investors are still missing. And here is the deeper point most people never hear. The silver market does not need everybody to panic at once. It only needs enough serious buyers in enough important places to keep squeezing the margin for comfort. That is how tight markets get dangerous. Not with one giant movie scene, but with quiet, repeated decisions that slowly remove flexibility from the system. If you want more breakdowns that help you feel the shift before it becomes obvious, are you part of this channel yet? Or are you still waiting for the crowd to tell you what mattered after it already happened? Now, to be fair, there are counter-arguments, and they deserve respect. Higher interest rates can hurt metals because they make cash and yield-paying assets look more attractive. A weaker global economy can reduce some industrial demand. And yes, silver sitting in warehouses is not always frozen forever. Some of it can be moved into deliverable form later if owners choose to do that. So no honest person should act like the outcome is already guaranteed. But warnings are not about certainty. Warnings are about risk building in a place most people are ignoring. A bridge does not need to collapse before an engineer says there is a problem. A doctor does not wait for total failure before saying a test result looks wrong. In the same way, a tightening physical market does not need to break completely before it starts sending a message. And right now, silver is sending one. The message is simple. This market may still look tradable, liquid, and normal on the screen, but the balance underneath looks less comfortable than many investors think. When a large amount of silver has already been demanded through delivery channels, when the ready pile is relatively small, and when geopolitical risk stays alive, the setup becomes fragile. Not doomed, not certain, but fragile enough that dismissing it would be a mistake. That is why emotional investors often get trapped here. They wait for perfect clarity. They want the market to ring a bell and announce the truth in plain language. But markets almost never do that. They whisper first, then move, then explain themselves later. And by the time the explanation becomes popular, the easy part of the move is often already gone. So what should a serious viewer actually watch? First, keep an eye on energy. If oil reacts sharply to Middle East tension, silver may not stay untouched. Second, watch warehouse data and delivery trends, because that tells you whether physical pressure is cooling or still building. Third, pay attention to whether price drops are met with fresh physical interest or simple fear, because those are very different kinds of selling. And fourth, watch the tone of diplomacy, not just the headlines, because contempt and delay can matter more than polished statements. Here is a challenge for you. Do you want content that helps you track the real pressure points instead of just reacting to the loudest headline of the day? And if you do, why not subscribe before the next twist hits? There is also a practical lesson here that goes beyond silver. The world trains people to think in headlines, but power often moves through inventory, logistics, and supply. We are taught to stare at speeches while the real signal hides in warehouses, shipping lanes, margins, and cost curves. That is true in energy, in food, in finance, and in metals. And the people who understand that usually do not feel smarter because they know more trivia. They feel calmer because they know where to look. Imagine a town before a storm. The news says the weather might improve by morning, but in the hardware store, batteries, bottled water, and fuel cans are already disappearing. If you only listen to the forecast, you may stay relaxed. If you watch what people are quietly taking off the shelves, you understand the mood much earlier. That is the difference between a headline story and a supply story. Silver right now feels a lot like that store. The public conversation keeps bouncing between hope and fear over diplomacy. But underneath, the market keeps reminding us that physical metal matters, access matters, and available supply matters. You can argue about timing, you can argue about price targets, but it is much harder to argue that these signals are meaningless when they keep appearing together. And the emotional pressure gets even stronger when you remember what silver represents. Gold is often treated as pure wealth storage. Silver is different. Silver touches industry, savings, fear, inflation, energy costs, technology demand, and market trust all at once. So when silver starts behaving in a strained way, it can be telling you more than one story at the same time. It can be saying the system is nervous even while the talking heads keep smiling. That is why this moment matters beyond traders. Prepared people listen when a market begins to show stress before the public fully understands why. Distracted people wait for a perfect headline that removes all doubt. Prepared people respect the signal. Distracted people argue with it until it becomes too loud to ignore. And history has not been kind to people who confuse comfort with safety. If you like content that treats you like a thinker instead of a spectator, subscribe now, because the next real advantage in markets often goes to the people who are willing to notice the quiet clues before the dramatic moment arrives. Now let's bring all of this together. Iran rejecting peace signals keeps a major source of global tension alive. That tension can support higher energy stress, inflation worries, and supply chain anxiety. At the same time, the silver market has already been dealing with years of deficits, heavy demand, and signs of strain in deliverable supply. Put those together, and you get a market that can look calm for an hour and then move like a trapdoor open beneath it. And that does not mean silver only goes up in a straight line. This is important. A warning is not the same as a guarantee. Silver can pull back hard. It can swing wildly. It can punish impatient people on both sides. But volatility is not the same thing as safety, and a dip in price does not automatically mean the stress is gone. In fact, some of the most important market moves begin with confusion. A peace rumor can hit, and silver can wobble. A stronger dollar can push it down for a while. Rate fears can make traders dump it on the screen, but if the deeper supply problem remains, those short moves may only hide the bigger tension instead of removing it. That is why surface action and real condition are not always the same thing. So if you are watching this and wondering what the real takeaway is, here it is. Do not let the market train you to think small. Do not reduce this story to one price candle, one social post, or one round of talks. Look at the chain: geopolitics, energy, inflation, physical supply, industrial demand, and investor trust. That chain is where the truth lives. And right now, every link in that chain deserves attention. Maybe the next headlines bring calm, maybe they bring another shock. Maybe silver pauses, dips, or explodes higher. No one can promise the exact path, and anyone who acts certain is selling confidence, not truth. But you do not need perfect prediction to recognize a serious warning. You only need the discipline to notice when the pieces stop fitting the easy story. And the easy story no longer works here. Not after years of deficits. Not after such heavy delivery pressure. Not after unusual import demand from major players. Not after a fragile diplomatic backdrop around one of the world's most critical energy routes. At some point, denial stops being caution and starts becoming blindness. So remember this when the next smooth headline tries to calm the room. Peace words can move screens, but they cannot instantly rebuild trust, refill supply, or undo pressure that has been building for years. Silver is warning that something deeper is still unresolved. And the people who listen early do not always feel comfortable, but they are usually less shocked when the truth finally arrives in public. If you want to stay ahead of the next quiet shift before it turns into a loud headline, subscribe now and stay close. Because in markets like this, the biggest danger is not volatility. It is falling asleep while the warning light is already on.